Welcome to This Week in Money. I'm Jim Goddard. Today, CIBC Wood Gundy's Ross Clark has the latest action on the major equity markets. Inside Track President Eric Hadik looks at near-term investments and how they work out, looking at business cycles. Former federal cabinet minister Paul Hellyer talks about his latest book, Money Mafia, A World in Crisis. He warns international trade agreements will harm Canada's economy. He also rates how the Trudeau government has been doing so far. Payton Nyquvest for Mackey Research will take a look at the Canadian equity markets. And Larry Reaugh, the president of American Manganese, will talk about how the lack of an Uptick rule is hurting the Canadian junior markets. We'll talk to Ross Clark right after this.
GEM International is a new diamond explorer in the richest diamond producing country in Africa, located next to the fourth largest producing diamond mine in the world. International Spotlight is on an 1109 carat diamond recently discovered in Africa by a fellow Canadian junior with a proven operator and finance team. GEM International trades on the TSX Venture Exchange, symbol GI. Visit us at gemdiamondmining.com.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark, investment advisor at CIBC Wood Gundy, Vancouver. Welcome back to This Week in Money, Ross.
Good to be with you, Jim.
A little argument, what's going on here? Is it the Trump influence or is it seasonality running the U.S. equity markets?
Or is it the influence of Trump's selections? So that's with a number of the Goldman Sachs people now looking as though they are going to be part of the administration, it's definitely helpful for equity markets. But clearly, strength in the U.S. dollar. It had a minor pullback in the middle of this week, but ended up closing off very strong once again. Equity markets definitely seeing the seasonality play. We did some work over last weekend looking back and seeing not only just the fact that we had made new highs in November, early December, but if you look back at any stretch where it made a new 4-month high in that time window, they would typically, I think it was only one example we could find going back to the 1970s where the market didn't continue to stair-step its way up very well into the first part of the year. If it pauses and turns at that point, that would be negative, but most of the rallies carry you at least into the middle of January. Very, very small pauses usually along the way. And if it's anything like when we look back and see the momentum style of move that we've just experienced in this last 2 weeks, then you're clearly looking at examples that would be like 2010 or the dot-com mania, the fourth quarter of 1998 or the fourth quarter of 1999, when the markets had pauses in October, come to life and then run very, very strong into the year, and as money managers clearly want to show that they've been participating in the moves. And that's the look we've got to this one right now. I think look for the early part of January before you've got any potential for a really big breather.
Oil over $50 a barrel really helped the Canadian dollar over the past week.
Yeah, the Canadian, we've talked about how it's been underperforming relative to the oil market for the better part of, since April. But in this last 10 days, Canadian has finally started to participate better. And it's up against, if you take a look at the downward channel that it's been in against the dollar since April, it's up testing the upper end of that right now. So this is where the challenge will come in. If the oil market does punch here, and we'll know how things are going with the non-OPEC countries here over the weekend, just what action we might be looking for next week. But if oil can push through this $52 level, then that becomes fairly decisive. Because a year ago when we were looking at oil, we found that there was a decennial type of pattern, that on the fifth year of a decade, you'd invariably be putting in a low, and if you could turn out of that low, it would rally for 8 to 9 months, take a pause for a few months, and then would rally for another 5 to 7 months. So this time around, we bottomed in February down at $26, gone up by 100%. which is pretty much the norm out of the 1985, 1995, and 05 markets. So this is the pause right now, and we're having this pause since September in what is normally a very weak time of the year. So if we can get through this weak period and then get into the late January, February stretch where the positive seasonals kick in, could be a really interesting first half of next year for oil.
Natural gas, of course, doing quite well with the cold weather setting in.
Oh yes, yeah. Now we were looking at El Nino and La Nina as the type of influences out there. You would expect that the nat gas price, and in particular the stocks, should have a very good first half of next year. Typically, those would run into the spring, so it's off to a pretty good start.
Ross, thanks for chatting with us.
Always glad to be with you, Jim.
My guest has been Ross Clark, investment advisor at CIBC Wood Gundy in Vancouver. Coming up, Eric Hadik next on This Week in Money.
Always consult your investment professional before making any investment decision.
I'm Larry Reaugh, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Reaugh, at 778-574-4444.
This Week in Money is archived online at talkdigitalnetwork.com.
My guest is Eric Hadik, president of InsideTrack.com. Welcome back to the show, Eric.
Oh, thanks for having me back, Jim. Great to be here.
An interesting interplay between gold, the dollar, and the U.S. election.
Yeah, I continue to focus on that, and I know you and I were talking back in early March, and again mid-year, and again in October, November. And one of the things I kept emphasizing 6-8 months ago and right on up to the election is that there is a strong correlation, at least for the last 3 or 4 decades, between the dollar's movement and the administration in power. And that everything in my dollar analysis, which was showing a final rally in late 2016, maybe stretching into early 2017, and a top after that, was strongly favoring a Republican in office. And, I was saying that even before Trump became the candidate. But if you just go back since the 80s, and I think that one of the watershed events or periods that solidified that correlation was the mid-80s, and you had the Plaza Accord, and then you had for at least a year or more, you could barely turn on the TV without seeing James Baker on one talk show or one financial show or one news show after another talking down the dollar. Every time it would start to bounce, he or some of his underlings would get out there and talk about the benefits of a weaker dollar. And of course the primary benefit of that is increasing U.S. exports. And for the next 30 plus years, we've seen a strong correlation with that. And the dollar did decline through the second half of the 80s, in the early 90s. And then when Clinton came in office, the dollar bottomed shortly after, and it rose on balance through his entire 8-year administration. And then it topped in 2000, 2001, kind of a double top, but right with the onset of the Bush administration. And the dollar headed down from 2001 to 2008, right until Obama was elected and Democrats came back into office. The dollar bottomed in 2008, really didn't do much for a few years, gave a secondary bottom in 2011, and has headed steadily higher ever since then. And all of the cycle work that I do and all of the technicals that I look at and a lot of the fundamental factors that I thought would come into play were arguing for a final dollar rally into late 2016, possibly a spike up in the second quarter of 2017, and then the onset of a multi-year decline, which would be, again, very indicative of a Republican administration in office. And, what did Trump really what carried him to victory was the votes in the Steel Belt and the Rust Belt and that promise of bringing back U.S. manufacturing, bringing back U.S. jobs, and really the key way to do that is increasing exports, and the key way to do that is allowing the dollar to drop. As long as the dollar is strong, makes for certainly cheap imports, and the consumers in America like it because everything's that much lower priced, but it's not good for U.S. manufacturing and U.S. exports. And one of the perceived ways to turn that around is to let the dollar start to decline. So from a fundamental perspective, it wouldn't surprise me to see that over the coming years. And as you mentioned, gold and silver are closely linked in there, and it fits in perfect with what I've been projecting for them for 2016 through 2019, the development and then the acceleration of a new uptrend in precious metals.
Right now, we're still seeing the price of gold decline. When do you believe that's going to stop?
I have, since late 2015, when I was looking for a major bottom in gold and silver, I've described the same scenario over and over again, and that was that we would see an initial 6-month advance in 2016. That would be kind of the firing of the starting pistol, that the bottom was in, and a bull market was slowly beginning to emerge, but that then we would see a pretty significant drop into either November or December of 2016, and that's when, for over a year, I've been projecting a secondary low in gold and silver. So we are right in that time frame. Gold has dropped to some key support levels. Silver as well. In some of the interviews you and I did back in mid-year and in July, I kept focusing on the $16 level in silver as a key support level that I thought the decline would reach or attack, and silver's gotten within about 15-20 cents of that, 15-20 points of that target. And so, for all intents and purposes, it has fulfilled that downside objective. So, I'm looking for a bottom in this time frame. I was talking about on an intermediate basis that I thought the dollar would peak in late November, early December, even though I think there will likely be a higher peak in the second quarter of next year. I was looking for a downturn in the dollar in December on an intermediate basis, and then thinking that that would also help to support gold and silver and at least trigger an initial rally from this secondary bottom. So I think that we are in that phase. There are some key signals that I need to see in gold and silver, which could actually unfold in the next few days, that would give an indication that a bottom is intact and that a reversal higher is unfolding. So I'm waiting to see them. But most of my analysis is pretending a late November, early December bottom in gold and silver. And since they have fulfilled almost all of the downside price and timing targets that have been discussed the last 3 to 6 months, they're in a very favorable position for a bottom to form.
Now, of course, we keep an eye on the price of bullion every day. What's been happening with the value of gold stocks?
They actually set their initial low a little bit before gold and silver, but most of my work is saying that gold stocks, or at least the overall, like the XAU index, is likely to spike to at least one more low, ideally in December. It could carry over into January. But that would be very typical of the lag and the divergence between the bullion and the stock prices. And it also fits with the possibility for a bit of a sell-off in equity markets in December, because the price of gold stocks are influenced as much by the stock part of gold stocks as they are by the gold part of gold stocks. So you got to have both, and that's why the gold stocks almost always bottom and top at different times than the actual bullion price.
Is there a way for a person to judge the difference between the two?
Not really, because there are the lag and or lead times that these turning points have seen through, even if you just look at the last 20 years, they have varied pretty significantly. And again, it's one of those things where the overall equity markets and what trend they are in is what has a strong influence on the gold stocks. So, like even right now, gold and silver, the bullion, I'm expecting to see a secondary low. That does not mean that they suddenly take off to the moon from there. A bottoming process takes some time, and, I said this even on a larger degree basis back in late 2015 and then in mid-2016 when I said we should see a substantial correction, and all I kept getting was a lot of feedback and or blowback against that, saying, no, gold and silver have turned, they're just going up, up, and up. Well, you can't really point to any major trend in any market over the last 100 years that has just gone straight up or straight down. There's a process, and there's a whole formation that unfolds. And so on an intermediate basis, I think gold and silver are going to need to go through that bottoming process here. And if they're kind of hovering near their lows but remaining above them, and you see a sell-off in equity markets, most likely you will see the gold stocks drop to new lows, even though gold and silver don't. Gold and silver might just be trading sideways, so they wouldn't have any strong positive or negative impact on the gold stocks. But then if you had overall equity markets going into a negative phase, that influence would exert itself much more powerfully on the price of the gold stock. So you have this interplay. You have to really be conscious of both factors, and that really is why I stress to my readers that you can't become tunnel visioned on a specific correlation, an intermarket correlation, where if this market does this, then this market has to do this, because there are always additional factors. Sometimes they're exerting their influence. Sometimes they're in kind of a neutral phase where a different factor will be the strongest impact on the pricing of that correlative market. So you need to analyze each market on its own, and that's why I say that even where the XAU index and the HUI index are showing me that there's still a strong possibility or even probability for an additional spike low in December, possibly stretching into January before they bottom. And all you have to do is look at a year ago, and the exact same thing happened, that gold and silver bottomed in late November. They saw a little bit of a retest of the lows in mid-December, and that was their bottom, and yet the gold stocks didn't bottom until January 19th, more than a month later.
Are you expecting to see another major correction in the equity markets early next year?
I do, and one of the things that I have been talking about for the last 2 years, and I'll try and synopsize this since it's pretty comprehensive discussion, but it's the interplay of larger and intermediate degree cycles. And in a way, it's kind of the same principle as I was just describing with factors that impact different markets. There's also stronger and or more influential and less influential cycles at different times, where they are in each phase of their progression either has a stronger influence or a weaker influence on an underlying market. And what I've been talking about is that in my work, I think that equity markets in general, and I include all the global indices in this, that they are in a topping process after completing a 40-year cycle of inflationary advances in stocks, in paper, even when you look at bonds, they've benefited from that same paper inflationary market of the last 40 years. And so I was looking at 2015, 2016 as being the topping process that would actually be more of sideways movement. And I compared it to 2000, 2001 in the Dow, even though there were different reasons for that, but where you would see 1 to 3 month sharp declines, you'd get all the bears foaming at the mouth, and then all of a sudden it had bottomed, and within a couple months it was right back up to attacking the previous highs. And just as it was doing that, the bulls would suddenly be re-energized, talk about how we were going, another 20% higher, and boom, a top would come in, market would roll over to the downside, sell off for 1 to 3 months. And you just saw that process go for about 18 months in the Dow Industrials. And I was comparing this cycle interplay to that time frame and saying that I thought we would see something very similar from the May and June 2015 peaks until late 2016, November, December, before other cycles would start to turn negative in late 2016, early 2017, and beginning in 2017, there would be a greater synergy of intermediate and longer-term cycles all in their negative phases, so then you have a much more negative influence on the markets, and there's a lot of other factors and indicators that go into that too. It's the synergy of all of them that I'm focused on. And one of those other cycles, really the second key cycle that I watch so closely in the equity markets, is a 17-year cycle, which has really been uncanny. And in late 2014, I started explaining why I thought that 17-year cycle would trigger a 15 to 20% drop in the middle part of 2015, and I pinpointed late April through late September of 2015 as being that initial drop, which was actually very similar to 17 years earlier in 1998, when you first had the Asian financial crisis, and then piggybacking on that, the Russian ruble crisis, which drove equity markets down in mid-1998 for about 15 to 20%. They then resumed their uptrends, gave one final rally into the early 2000 peak, and I was looking for something similar from that specific cycle, that 17-year cycle, from late September 2015 into late 2016, early 2017, which would be exactly 17 years from the 2000 peak. At the same time, there were other cycles exerting alternating negative and positive influences, so I didn't expect it to look the same as 1998 through 2000. But the point of all that is, hopefully I didn't completely confuse your listeners, but the point being that when we hit early 2000, and that 17-year cycle was no longer in any positive phase, that would give the convergence and the synergy of all these other cycles, the 40-year cycle, but then several monthly and even weekly cycles that I've discussed, that give them more of an opening and an opportunity to drive the markets lower in 2017. And so I am looking for a progression of declines. I don't think it's going to be all at once. There are still key indicators that need to kick in to confirm that. But one of the things that's really been kind of interesting to me is how the NASDAQ 100 has been trading in here. And it, in just the last month or two, just barely retested the high that it set in early 2000. So it's got that 17-year cycle playing very closely, but from a major price perspective, too, it's taken 17 years to get back to where it was in early 2000. So this is a major resistance level that it has been bumping up against. And often a test like that will trigger at least a 1 or 2 month pullback, even if it doesn't materialize into something larger degree than that.
Eric, thank you so much for chatting with us.
Thanks for having me back, Jim.
My guest has been Eric Hadik, president of InsideTrack.com. Coming up, former Canadian Cabinet Minister Paul Hellyer, who will talk about his new book, Money Mafia, A World in Crisis, next on This Week in Money.
Gem International is a new diamond explorer in the richest diamond-producing country in Africa, located next to the 4th largest producing diamond mine in the world. International Spotlight is on an 1109-carat diamond recently discovered in Africa by a fellow Canadian junior with a proven operator and finance team. Gem International trades on the TSX Venture Exchange, symbol GI. Visit us at gemdiamondmining.com.
This Week in Money is archived online at talkdigitalnetwork.com.
My guest is Paul Hellyer. He's one of Canada's best known and most controversial politicians. He's been a former deputy prime minister, defense minister, and transport minister. His latest book is called Money Mafia, A World in Crisis. Well, Paul, you're 93 years young. You're talking to us from Toronto, and welcome very much to This Week in Money.
It's my pleasure.
First of all, can you tell us a bit about your book, Money Mafia, A World in Crisis? It sounds like you wrote it with maybe Donald Trump in mind?
Well, not exactly. I wrote it because so many things were going on in the world that people didn't know about. And it covers a wide range of material and sort of covers the world crisis, basically. And not only that, but prescribes probably a dozen things that should be done to solve the crisis. And the one of the most important, of course, is the monetary and banking system, which has been causing so much havoc for, well, centuries really, but especially the last few decades, and which is indirectly responsible for the results in the U.S. election, which you just alluded to. And basically, people were interested in jobs, so there were no jobs. They had disappeared, largely, as Mr. Trump said, due to trade agreements. And this is something that I deal with in my book. I deal with the major issues, all the major issues in the world today. And when NAFTA was signed, unlike the Canada-U.S. free trade agreement, where there was very little difference as far as employment is concerned, a lot of when NAFTA was signed, a lot of companies moved to Mexico, both from Canada and the United States, and took jobs with them. And then, of course, later on, a lot of them started going to Asia as well, leaving people behind with no work or having to work in McDonald's or or Starbucks or something like that, and they weren't happy about it, and understandably so. And the people responsible for this catastrophe, I guess you would call it, knew that it was going to happen and said something had to be done about it, but nothing was ever done about it. So no replacement jobs put in, and Mr. Trump just came along at a time when people were fed up and were willing to vote for change, basically. And I think that's what they're going to get.
Well, of course, with new technology, they said they'll return manufacturing to the U.S., but what about the example in China where Adidas shut down their million-person factory in China and moved it back to Germany where robots will make the running shoes?
Yeah, well, robots are going to be a problem, but what they have to do not only is make robots, but they have to start providing more services because the whole world's changing. And first of all, there are a lot of people who don't have the basics that we're talking about. There are millions of people in the world who would like to have running water and toilets and decent houses and maybe a small car of some kind and other things, but they don't have the money to do it. And there are a lot of people in some of their countries who have everything they need, and the shift is going to be that instead of just producing more vehicles and so on, that they're going to have to provide more services, better services for old age people that need looking after, and more health care and better education and maybe a wider variety of the arts, and certainly in Canada start living up to our promises for our Indigenous brothers and sisters who have been neglected for a long time, and make sure that they have potable water and that they have education that is comparable to ours, and so on. So there are lots of things to do, but those all require more money in the hands of government. And with the present system, where private individuals have a monopoly on creating money, that poses a problem. How do you get money to do all those things when private people, private banks, have a monopoly on creating money, even though the people own the patent? And the answer is you can't. You have to either borrow it from them and repay principal and interest, when in fact no one creates any money with which to repay either the principal and interest or raise taxes. And we've just gone through that here in Toronto. The mayor has made himself quite unpopular in the last few days by proposing toll roads for the first time in downtown Toronto, and hotel taxes and other taxes, which are, some people will accept it, but a lot of people don't have money to pay for it. I've noticed a few people on television explaining, well, it's a case of food or paying the extra money for the TTC, the extra dime a ride, and so on. So there's a shortage of money all around, and there's no way to solve the problem, no way, except the infusion of very, very large amounts of government-created debt-free money. Now, this is new in recent times. There was low-cost money. In Canada, for example, the Bank of Canada provided a lot of, low-cost money for 35 years, from 1939 to 1974. And that enabled us to get out of the Great Depression, which I remember very well because I lived through it, and then to finance our part in the war, which was extraordinary for the size of our country. We played a significant part, and the Bank of Canada helped us finance that. And then after the war, they helped finance our infrastructure right across Canada. the Lawrence Seaway, the Trans-Canada Highway, new airport terminals, new ports, and new roads, and all sorts of things. And they made the money at near zero cost, just the cost of administration deducted. And that worked beautifully for 35 years. We did all kinds of things, and we had opportunities. In my generation, there was never any question about somebody getting a good college education and not being able to get a job, because there were jobs, and you could count on one if you had anything going for you at all. And it worked splendidly. And all of this was done with practically no debt. And to the dismay of people who are not interested in the facts, without inflation that was any greater than the average of the OECD countries. So it worked well, but then in 1974, the governor of the bank just unilaterally and without consultation with the prime minister or the parliament, changed the rules, abandoned his shareholders, and started taking his orders from the Bank for International Settlements in Basel, I guess it is, Switzerland. And it's been downhill ever since.
Is there any way for Canada to reverse this?
There is at the moment, yes. And a number of colleagues of mine got together a couple of years ago and came up with a plan which we call well, they've added the word new recently, the social contract between the government and people of Canada, which was designed to do two or three things. It was designed to provide immediate money for relief. When I say relief, I'm referring to the fact that for 45 years, but especially in recent years, and especially since 2007, we've been underfunding all of these important things. We haven't spent enough money on them, so we have accumulated a backlog of things that need to be done. So the plan was to provide a lot of money for a reasonable length of time. In fact, $150 billion a year for 7 years, to be split 50-50 between the government of Canada and the provinces and territories on a per capita basis. And the other aim of the thing was to reduce the leverage of the banks, because the system we had from 39 to 74, in effect, was one where the money creation business was shared between the government of Canada, the bank, and the private banks. And it worked well. But then they got a monopoly, and we didn't get anything. So this is really to replace the kind of sharing we had before on a formula that is lasting and would stand up forever. And so at the end of 7 years, the banks would have to have 34% cash reserves against their deposits. And the new money created would be split 66% for the banks and 34% for the government. That's compared to 97% for the banks today and 0 for the government. So it would be at the same time not only introducing a workable system to replace one which is, well, first of all, corrupt with leverages of 20 to 1, and also one that would work for everybody. It would work for the banks. They wouldn't have quite as fat profits as they have now, but they would have good businesses, and it would certainly work for governments because they would have enough to balance their budgets at all levels, federal, provincial, and municipal, and at reasonable tax rates. So it's a system that was put forward, and unfortunately, the government of the day and the present government, neither one of them, will look at it seriously. And worse than that, they've been toying with trade agreements, CETA in particular, and the Trans-Pacific Partnership behind it, which would make it impossible to do that. Because if the government insists on ratifying CETA, then it would apply to the financial services of both the federal and provincial governments. And if you started to do what I've just described, which is what really, it would be like day after night for Canada's economy. It would start to grow at, 4 or 5% a year. The unemployment would come down by 50% in 2 years. And there would be enough money for all levels of government to get ahead with infrastructure without having to sell our assets to foreign banks. And it would work just splendidly. But if CETA were ratified and put into operation, then those great big European banks, which have become so powerful over such a long period of time, would sue us for tens or hundreds of billions of dollars and make it, in effect, not viable. So we've got a lot at stake there.
Is the Bank of International Settlements the central banker's central bank? Who runs it, and what are your thoughts on it?
My thoughts on it are that it should be wound up. And that's what I say in my book, that it is a bank with a very questionable history. It actually supported the Nazis before the Second World War, during the Second World War, and after the Second World War. And still, it is the bank of banks, which, according to somebody who studied the thing very, very, very extensively, and I quote in my book, is running the world. And they're running it not for you and me and for the working people of the world, or the 99% to sort of sum up the facts, but for the 1/10 of 1%. And the 1/10 of 1% call the shots because they control most of the central banks, including the Federal Reserve System. And consequently, they just do whatever they darn well please.
Is it any coincidence that the big Canadian banks contribute the same amount of money to both the Conservatives and the Liberals?
Yeah, I think it's an interesting coincidence, isn't it? They used to vary it a little bit. They would base it on who they thought was going to win, and maybe go 60-40. But then if they didn't know who was going to win, they'd have to split it 50-50, and 0 for the NDP.
Is the International Monetary Fund related to the Bank of International Settlements?
The International Monetary Fund has been nothing but a collector for the big international banks. It has, as you know, it was designed at the Bretton Woods Agreement in New Hampshire in the 40s to make it possible to have the gold standard, and for one country to borrow a little bit if they had been importing too much and not exporting enough, and so on, so that they wouldn't have to devalue their currencies. But then when we went off the gold standard, when Richard Nixon finally went off the gold standard altogether, had no further purpose. But like many government organizations, it didn't disappear, which it should have. It just hung around and paid big salaries, tax exempt to the people working there. Well, then when Paul Volcker pulled his big stunt in 1981-82 of nearly crashing the whole system, he put the banks, the New York banks, in the position where there was no way that the say the countries of South America could pay their loans with those high interest rates. So all of the New York banks were technically insolvent and were on the point of really, I guess, panic. And he got them all in a room and said wouldn't let them out until they agreed to lend more money to these countries until he could get the IMF to ride to the rescue. Well, that was the beginning, and then after that, of course, they've been used ever since, not to rescue the people of the countries, including the South Asian countries, as part of their deals to lend the money, tell them how to run their countries, and bring about what they call the IMF recession. But it set this precedent of the IMF really being an enforcer for private enterprise, and with the people's money, with our money. And so I'm not the only one that says it should be wound up. And in my book, I quote 2 or 3 other people, including some names that you wouldn't expect to see there, as to why it should be, and then it should at the same time write off the debts from the poor countries and give them a chance to start breathing. That would be the greatest service that it could render to humanity. But again, instead of doing that, what they're asking for is more and more money from the donor countries to let them put bigger stakes on the table. And it's the wrong way to go. And it would not be necessary if the money creation function was shared. That would solve the problem. But as long as the money creation function is a monopoly, the system will not work, despite all of the tinkering of the G20 since it started to try and put boilerplate on the old leaky ship. And it never will work. So now they're talking about all sorts of alternatives like positive money and helicopter money and so on. And our system, I would say, after a lifetime of interest in this subject, is probably the best one on the table because it allows for a smooth, steady transition over a long period of time. It wouldn't disrupt markets unduly the way that most of the suggestions would. Some of them would anyway. And it's not an expedient. It's a question of principle. It's the principle of sharing the money creation function and changing the system so that the 62, would you believe this? Now listen carefully. 62 families own half of all the wealth in the world. 3 or 4 years ago it was 88, and it came down to 80, and now it's 62. I can't get my mind around this because I start going through the cities, like Peking and Shanghai and Tokyo and then Vancouver and San Francisco and Los Angeles and right on across the country and New York and Philadelphia and across the pond and London and Manchester and Paris and Bonn and on and on. And every second one of those is owned lock, stock, and barrel by those 62 families that you could put on one street in the suburban part of a city. And so the reason why? Because with a ratio of 20 to 1, they're buying assets for 5 cents on the dollar. So they are buying up the world for 5 cents on the dollar. And the great advantage of what we are proposing in our system is that at the end of 7 years, assuming that the rest of the world followed suit, which they should do, they would have to pay 50 cents on the dollar, not 5 cents. And that would slow down their accumulation of assets remarkably. And that is the way it should be because the present question is grand larceny. It is immoral. It is, I have to choose my words carefully, but it is just so long. And, these people, many of them are trillionaires. But they have so much money that they can keep their names off a Forbes list. And I guess that's maybe by the same means that they keep the United States Congress from nationalizing the Fed, which they have to do if they ever want to solve their problems on the monetary front.
Are the New World Order and globalization being stopped in their tracks by President-elect Donald Trump?
Well, wait and see. I haven't. That is the most important question that anyone can ask. But the answer won't be known until we see whether Trump is really changing things or whether he's just changing a few of the horses.
Well, so far it looks like he's surrounding himself with nothing but billionaires and former generals.
Yeah, and if the former generals are the ones who want the New World Order, nothing will change. And if they are the ones that maybe had some reservations, something will change. And I've asked a couple of people if they knew much about 2 or 3 of the nominees, and they said no, but we're hoping to get a little more information. But it's really only time that will tell whether we're going to change this diabolical plan to really establish a world government that is a dictatorship, is unelected. It's a world government of, by, and for the rich elite, the top 1/10 of 1%. And if it continues, then we won't have gained the advantages of the sort of change that Trump was sort of alluding to during the election.
Are trade agreements good or bad for Canada?
Basically, they have been bad. This is a bit of a tricky question, but as far as I can see, we haven't had a trade agreement yet that has yielded us more than it's cost us. And it's cost us dearly in some areas. It has decimated the middle class. And I was thinking the other day, I used to have I still have a little capital, but not much. I used to have a bit that I invested, and it was in International Nickel, Alcan, Stelco, McMillan, Blodell, all these companies, and they're all gone. And with them, all of the top jobs and lawyers and advertising people and so on disappeared. And so it's been a one-way deal, one-way thing in most areas. Now, I know there are winners and losers, so I'm not saying that no Canadians benefited, because some did, and some fairly handsomely. But I think in a lot of cases, the ones that benefited most handsomely were the banks who helped finance the takeovers of a lot of Canadian companies and benefited in the financial part of the deals, and also maybe in cases where people had stock and was taken over, that they did fairly well. But overall, I would say that the average Canadian was better off in the sense of contentment and happiness and belief and in the future and in their capabilities to do something and to benefit from it 20 or 30 years ago than they are now. At least that's my reading on it. I think it's fairly accurate.
Trump says he wants to rip up the Trans-Pacific Partnership. Should Canada follow his lead, and what's the real story behind this partnership?
He should. Well, it's the sort of the next thing after CETA, and one worse. Each one has been worse than the previous one. And CETA is sort of the one that would really end our hopes of ever having a robust economy again. And then Trans-Pacific Partnership is even worse, and it would have more effect in some areas. The purpose, the motive for these big agreements was to transfer power from governments to transnational corporations and the banking cartel. It was all part of the New World Order, that instead of having to send the army in to take people over, you just buy them out, make them so poor that they can't do anything, and then take away their powers by transferring them to the transnational corporations and the international banks. So that's what the whole trading business is about. That's the reason it started. They could have had a trade agreement between Canada and the United States that didn't need to mention anything about the dispute settlement mechanisms. That was the kicker. Why we agreed to it, I will never know, because it actually gives foreign companies more power in Canada than we Canadians have. And boy, if that isn't a mistake, if that isn't wrong, I don't know what is. But I guess the government was so anxious to get a deal that they just went ahead and signed it. But that is what the trading things are all about. It is part of the takeover process of the New World Order, and it's worked so smoothly so far that it makes you wonder if, well, they're very clever people, and they had what I call a business plan, and they just keep following it, and it's been working so far exactly the way that they had planned it.
What do you think of the Justin Trudeau government's performance so far?
Well, in some small things, he's done quite well, and he's very good at making promises and working with people like the Aboriginals to give them a little hope, and then, of course, proposes pipelines that takes away the hope of some of them. But I was asked by the Quebec editor of Maclean's, this question just at the end of Trudeau's first year. I said he had done quite a few small things well, and it would depend on the big things, the big decisions. And the big decisions are whether to use the Bank of Canada or not, and whether he would sign CETA or not, and whether he would go for an infrastructure bank or not. Now, as of this moment, he's negative on the most important one that he should go for, which is the Bank of Canada, and he's going for the other two, which he shouldn't go for. So there's 2 out of 3 negative. And I'm hoping, you may or may not know, that I, along with a couple of colleagues, have launched an action in court to try and prevent the government from ratifying and implementing CETA. And in effect, I'm trying to save his bacon. It would bail him out from making probably the biggest mistake that any prime minister has made in the last, certainly in my life, and give him a chance to perform in other areas. But he's getting advice from public servants who have been totally taken in by this one world order thing, and they're just pushing it, and it's pretty hard to say no to them because they're very persuasive. And he's taking advice on the monetary front from people in the finance department who don't understand the basics of money and banking. There isn't a single person, I don't think there's a single person in the finance department who really understands the basic workings of money and banking. So he's getting a lot of bad advice, and as a result, he's doing these 2 things, which I think are just dreadful and will, keep us in penury forever, and not the one thing that would get us out of it. So we're going to see if we can get the courts to save us where the politicians have let us down.
Where's that court action taking place?
It's in the federal court.
How much behind-the-scenes influence does the monarchy have in Canada?
I would say practically zero.
Any thoughts on who might be the next leader of the federal Conservatives?
No, none at all. And the only thing I know about politics for sure after a lifetime is that it's unpredictable.
Yes,
you can certainly see that in the United States recently, and halfway through the Canadian election, a little over a year ago, you would never have predicted a majority for any party, but it happened.
Paul, where can people find out more about your book?
They can find out more about what's going on at CanadianBankReformers.ca. That's www.CanadianBankReformers, all one word, .ca. And they can find out more about my book from my website, or they can buy it from Amazon or from my website, which is paulhellierweb.com. And there are two books, really. The first one was called Light at the End of the Tunnel, a survival plan for the human species. It's a very good book, and I just got my third quarter royalties on it, and it's still selling very well. So it must have something, because it's over 4 years old now, and it's still selling. So and that's because I think, without bumping it up too much, it is a good book, and it's sort of the precursor to the Money Mafia, A World in Crisis, which I had no intention of writing, but I found out so much in the 2 years between them that was going on in various areas, that I just felt really duty-bound to write another book. So that's where the Money Mafia came from. And both books have lists of things that the United States and the world have to do if they want to end the world crisis and have peace and prosperity.
Paul, thank you so much for being on This Week in Money.
It's a pleasure indeed.
My guest has been Paul Hellyer, former Defense and Transport Minister, former Deputy Prime Minister. His latest book, Money Mafia, A World in Crisis. Coming up next, Payton Nyquvest on This Week in Money.
I'm Larry Reaugh, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Reaugh, at 778-574-4444.
This Week in Money is archived online at talkdigitalnetwork.com.
My guest is Payton Nyquvest. He's an investment advisor at MackeyResearch.com in Vancouver. Welcome back to the show, Payton.
Thanks for having me.
How did Canada's equity markets do?
Well, the TSX had a high of 15,312. Low was 15,075. Closing 15,312, up 232 points for the week. The TSX Venture high of 754, low of 746. Closing at 748, down 2 points, so just about flat. And the CSE had a high of 807, low was 775, closing at 782, down 25 points for the week.
Did the announcement that OPEC will freeze production levels for at least 6 months help the Canadian oil patch?
Yeah, for sure. You kind of seen almost a 20-30% bump in a lot of the in the majors there, and continuing to go higher.
The American markets, of course, reflecting optimism under a Trump administration. Is that actually having a washover effect in Canada?
I think everybody's got a lot of speculation as to what's going to happen when he actually comes in. In talking about those tweets, you hear about him downplaying a lot of the original issues, and then all of a sudden, he'll lash out about some tweet or something, and all of a sudden there's concerns again.
Payton, thanks a lot for chatting with us.
Thanks for having me.
My guest has been Payton Nyquvest. He's an investment advisor at MackeyResearch.com. Coming up, Larry Reaugh next on This Week in Money.
GEM International is a new diamond explorer in the richest diamond producing country in Africa, located next to the fourth largest producing diamond mine in the world. International spotlight is on an 1109 carat diamond recently discovered in Africa by a fellow Canadian junior with a proven operator and finance team. GEM International trades on the TSX Venture Exchange. Symbol GI. Visit us at gemdiamondmining.com.
My guest is Larry Reaugh, President and CEO of American Manganese. On the web, you can find them at AmericanManganeseInc.com. Larry, welcome back.
Well, Jim, I'm glad to be here. We're seeing a little winter weather, but that's to be expected.
Well, yeah, the first major snowfall for Vancouver in 1,000 days. We were due. Larry, the last time we talked about the Uptick rule was April of this year. Since then, the junior markets have been somewhat buoyant without an Uptick rule. Larry, have you done any recent articles on the Uptick rule?
Actually, Jim, I haven't done an article since Dan McGarty out of Washington, D.C., and I jointly did an article that was published in the Vancouver Sun here in Vancouver, and on the Mining Journal website around the world. But we haven't done an article on that. I've certainly, though, kept in contact with my shareholder base about what the Uptick rule is all about, the fact that there is no Uptick rule, and kept them informed about that.
What effect has shorting without an Uptick rule had on American Manganese stock prices?
Well, you've seen the volatility in our stock. I mean, we've traded 250 million shares in 4 months. That's a B, quarter of a billion, 260 million actually. And that's a lot of stock to go through. We've gone from beginning of the year at about 1 cent to a high of 38 cents. But there's something that's been holding the stock back. With that kind of buying frenzy, you'd expect the stock to have been much higher. But not there being no Uptick rule, of course, it's like blood in the water for predator traders when they see this kind of volume to come in and trade, a penny or two. Some go in for daily profits, and others go in to try to drive the price down to make a huge killing, and that's probably what we've been seeing here in the last couple of weeks.
What can shareholders do to protect themselves?
Well, the only thing a shareholder can do to protect himself is to, first of all, to recognize and accept there are no short rules or Uptick rules in Canada. So there's no regulation on it, and to understand that these guys have a certain formula which they operate by. And if they are aware that you might be coming out with good news or something like that, they can gang up and do a lot of selling to make that news look like it's bad. But you have to reckon as a shareholder, rather than get spooked out of stock that you paid 30 cents for and sell it at 25 cents, the smart thing to do is to go back and look at the company and see what solid progress the company has made. And we've made some very solid progress. So the due diligence should be done on the company. Look at the press releases. Look at whatever other information that we have out there. And look at those before you start believing the blather on the billboards. Naturally, predators are not going to be talking good about the management or the company or its process or any other thing. It's all going to be, they're going to zero in on certain things. For example, there was, in the last month, there was 700,000 shares sold by insiders. Nothing was said about the fact that one of those insiders bought back 450,000 shares. But they made the implication that the company, the management, and the directors did not believe in the company. But, directors are like any other shareholder out there. They have to arrange, before the year ends out, certain tax, accept certain tax gains or losses, and that may require buying or selling of shares. or they may need money. In the case of a company that was starving to death for 5 years, which was Amy, there's a need for money because nobody's received anything that's worked on it. And so they sell some shares, just like any other shareholder. I mean, out of $260 million, the amount of stock that was sold represents 0.3% of the total sales. Is that detrimental to the company? No. But the perception that the predators want to make out there is that we're bailing. I mean, gee whiz, out of probably the insiders hold about, totally maybe 25 or 30 million shares with some of the people that are also on our advisory board. And, 700,000 shares is not a lot of selling. I'm not making excuses. I'm just saying that this is going to happen off and on. Markets come and markets go, and people have immediate needs or long-term needs, or maybe they've been borrowing money to support the company, and they want to alleviate those bills by paying them off, and they may sell some stock. So that is in itself, as I explained it, does not appear to be a big thing, but it certainly can be blown out of proportion on the bullboards. And this is, basically what the predator wants to do. He looks for any sign of weakness, and then he goes for it. Now, remember, anybody that's a shareholder isn't going to be in there, knocking management and the process and its and the Amy company itself. This is predator trading. So the shareholder has to basically look at the reason he bought the stock to start with. And eventually, the company will reach its goals, and that'll increase the value of the company. And you have to remember that short traders now, especially the longer-term short traders, are putting themselves at risk. If there's 10 or 20 or 30 million shares short on the company, most of it undeclared, then what happens if something out of the norm happens? And I'm not saying I know anything out of the norm that's going to happen, but potentially we're in a hot area. Something could happen at any time, and but that's a hypothetical. Then they'd have to cover, and they could get badly burnt. So, the greater risk now is in selling stock you don't own in a company that has a great technology on its hands than to buy the stock, because eventually, it will be recognized in the marketplace.
What can companies do to protect shareholders?
What we can do is we keep going and diligently moving the company through its milestones. We've got other things to do. We want to make sure that our patents are solid. So we've got some test work to be done. That'll be coming up very soon. We're going to be implementing that. And that will keep us busy for the next, keep the company management side busy, just being able to cross the I's and dot the T's and make the patent foolproof, and that will be an ongoing situation. So there'll be news coming off of that. And, of course, we just got back from the NatBat, and we've exposed the company to a good cross-section of the people that should be interested in our recycling process. It's getting to be more and more and more that the company will be emphasizing the fact that, yes, we can, it appears that we can recycle cathode material, that, yes, there should be a demand for it out there. Less and less companies are looking at making wall units out of them, which is just a stopgap. Eventually they have to be recycled. So when you look at the environment, if you want to basically say that the company is, or the companies that manufacture batteries and EVs are conscious of the environment, but if they're not looking after their waste in a prudent manner that recycles those cathode materials, then that kind of lays a lie to what they're doing. So they have to start getting serious about recycling. And I say that because when I was at NatBat, my impression was that companies were basically not paying the attention that they should for the recycling aspect of it. That was my impression. And that we did get a good reception. We did have a lot of people coming up and talking to the Cometco folks and also to myself, and that, in itself tells you that, hey, we're on the right track. And what comes out of the NatBat? Well, you may be seeing some of that today and the sudden rise of the stock, but I don't know. And but I do know that anybody that's going to be interested in us is probably want to be an owner of the recycling shares, or they'll want to. The company itself will want to eventually own a part of it or all of it, and so we just keep moving diligently ahead. Don't lose our focus, and as I said earlier, people shorting the stock are putting themselves at greater risk than the people that buy the stock. I mean, the stock is certainly much more advanced and worth a lot more today than it was when it was 38 cents. We didn't have we didn't have the patents applied for or anything like that at that point. Now we have, and which gives the company a nice security blanket to move ahead with what they're doing. And that's all the company can do. We can't change the regulations. The regulations are such that there are none. And, reporting of short positions, well, I think that's up to the company. When a company trades 260 billion and there's 1 million shares, or 250 million shares, and it's obvious that the volatility is caused by trading back and forth, and that's shorting and buying and shorting and covering the shorts and on a daily basis, and also the long-term shorters are hoping that they can grind the company into dust, and for my personal opinion, is that I can't see that happening anymore. We've crossed that barrier. So I think being aware of what you're up against in the market is crucial. I started talking about this and with you, Jim, I think about 4 years ago, and even a year ago. People were getting glassy-eyed when I talked about it. They rather than go do their own due diligence on it, they just took it as bunk. But now you're seeing that the light is being shone on a lot of these short players, and it's specifically coming off of the major exchange, Toronto Stock Exchange. There's been articles out there that have been exposing the short trading. So I expect that at some point there will be regulations coming back in. Certainly they didn't put these regulations back in the 30s for no reason, and it helped lift the market off and helped them get out of the recession. So, or the depression, I should say, and so the same thing is going to happen here. But I think, and I'd just like to take this little opportunity here to wish my shareholders a very Merry Christmas and a prosperous New Year. And I think that we've got a tiger by the tail, and we'll just keep hanging on to that tail and trying to steer the tiger.
Larry, thanks for chatting with us.
Thanks, Jim.
That wraps up our show for this week. We'd like to thank our guests, Ross Clark, Paul Hellyer, Eric Hadik, Payton Nyquvest, Larry Reaugh, and thank you for listening. Any questions for This Week in Money can be emailed to info@howstreet.com. I'm Jim Goddard. We're back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at TalkDigitalNetwork.com. This Week in Money is a production of Howe Street Media Incorporated. Executive producer is Tom Allen.